And welcome to Inside India. I'm JP Ong, and here are your headlines. India's GST Council kicks off a two-day meeting that will decide on a tax structure in the country's biggest overhaul to the GST system since it launched. Less paperwork and more wafer work. Prime Minister Narendra Modi sets out the country's chip ambitions as advised to be a major player in the semiconductor space. And peace through strength. China putting on a mighty military display with Russian and North Korean leaders in attendance at its military parade in Beijing. Good morning and welcome to the broadcast. Before we get deeper into Indian affairs, we want to take a look at how Asian markets are now setting the stage for the Wednesday or midweek trading day. And again, a bit of a mixed bag with most markets just taking a step back once again, and also just a little bit of trepidation for traders from Tokyo to Taipei today. This also on the back of those rising bond yields over that has really hit and questioned and tested equity valuations across Asia and across global markets. We are seeing the Nikkei 225 actually in the red today, just down by about 0.3%, with bond yields or JGB bond yields also trending higher. But we're seeing the South Korean Kospi actually defying the downturn today, up by about 0.4% on the back of that revision to their second quarter GDP figures that might be just giving a little bit of a cushioning, that is, for traders out in Seoul. A bit mixed also for greater Chinese markets. The Hang Seng holding on to dear life and holding on to those very, very slender gains, while the Shanghai Composite also down by about 0.3% so far today at 3,848 points. Indian markets also set to come online, but in about 45 minutes. In the meantime, here's what Gift Nifty futures are indicating. And so far, we are seeing that the Gift Nifty is also hinting at gains once more today. Not by much, but again by about 50 to 60 points actually over the Tuesday close. We have to remember that yesterday we did see a very slight step back, that is, for the Nifty 50 actually, on the back of perhaps some questions about equity valuations there. But overall, it is still holding on to gains of about 4% year to date. Meantime, Prime Minister Narendra Modi speaking at Semicon India, touting the country's resilience and growth, even amid global headwinds. He pointed to what he called economic selfishness as a challenge, but stressed that India continues to rise.
At a time when there are concerns in the economies of the world, there are challenges created by economic selfishness. In that environment, India has achieved a growth of 7.8%.
Meantime, at a different event, the Indian Trade Minister gave updates on the country's multiple trade negotiations. The Minister Piyush Goyal saying India and the U.S. are still negotiating an agreement. His comments follow President Trump criticizing the relationship with India as, quote, one-sided.
As we continue to have newer trading arrangements with the European Union, with Chile, Peru, New Zealand, a second tranche of Australia and Oman, all of these are FTAs on the anvil. We already completed Mauritius, Australia's first tranche, the four-nation EFTA bloc, UK, UAE. Lots have happened, lots more to go. But all of the US, we are in dialogue with them for a bilateral trade agreement.
Meantime, Russian state agency TASS is quoting Foreign Minister Sergei Lavrov praising India for not bowing to U.S. pressure to stop buying Russian energy. Speaking on the silence of the Shanghai Cooperation Organization Summit, where Prime Minister Modi and President Putin met, Lavrov accused the West of trying to block the emergence of a multipolar world. And markets will be watching for updates from India's GST Council meeting that kicks off today. Chaired by Finance Minister Nirmala Sitharaman, the two-day meet will discuss major reforms aiming to simplify the tax system by next month. Proposals include consolidating 4 tax slabs into a 2-tier system with a 40% rate for sin goods. While a lot of the goods will be cheaper after the overhaul, a document seen by Reuters suggests the taxes on luxury cars could still be hiked. We are also watching what's happening in the bond markets today. U.S. 30-year yields bumping up against the 5% level. That's their highest since mid-July, as we saw a rise in yields in the United Kingdom and across Europe. Concerns about rising fiscal deficits haunting investors right now, with investors stateside returning from their Labor Day weekend, reacting to a U.S. federal appeals court ruling that Trump's tariffs are illegal and could pave the way for a Supreme Court battle. President Trump has said he will ask for an expedited ruling from the nation's top court to overturn the decision. The developments raising concerns about the U.S.'s trade picture and potential lost government revenues from tariffs. Yields currently trading at about, we take a look at the 10-year yields now, just inching higher at about 4.28%. But the U.S. 30 yield, as we mentioned, one to watch out for because it did briefly touch 5%. It has eased, but again, continue to feel some upward pressure about 4.98%. We've also been seeing rising yields in Europe. Take a look at gilts right now out in the UK. London showing that gilts are, 10-year gilts that is, just trending just a little bit lower, but in sharp contrast to those 30-year gilt yields, which are now trading about 0.1% higher or up by about 0.8 basis point at 5.70%. 2-year gilt yields also trending higher by a touch at 3.99% so far in today's session. Out in Germany, and Bund yields also just looking a bit challenged in today's session, although we are seeing just a little bit of a come down now for 10-year Bund yields, that is down to about 2.78%. The 30-year Bund yield, though, trending higher. It seems that most of the upward pressure for a lot of these yields at the moment, or bond yields across global markets, is resting solely on the 30-year yield so far in today's session. But again, raising concerns and perhaps also making itself felt in equity markets as valuations are being tested and perhaps repriced on the back of some of these gyrations and moves in the fixed income market. And also taking a look at JGB yields, as we mentioned a while ago, just to wrap things up. And we did mention that there were signs of these yields also inching up in Tokyo. Take a look at the 10-year yields now in Japan, up to 1.625%. 30-year JGB yields also at 3.265% higher in today's session. Meanwhile, the 2-year yield is inching lower, though, at about 0.86%. Gautam Dugat is the Director and Head of Research of Institutional Equities at Motilal Oswal Financial Services, and he's here to talk to us about how all this might be influencing Indian markets. They do maintain a rather upbeat picture or recap of Indian markets, especially on the back of solid signs that corporate earnings in India are indeed rebounding. Gautam, thank you so much for joining us today. I do want to start off with the outlook on Indian markets, because one of the things you folks highlighted actually are signs that there's a recovery in corporate earnings out in India. Can you talk to us about what's impressing and why two particular sectors, oil marketing companies and non-bank financial companies, have been impressing more than others?
Hi, good morning. Thanks for having me. As we speak, we are in the midst of our 21st annual Global Investor Conference, and the backdrop for the conference has been a bit mixed. The corporate earnings for the first quarter just ended a week or 10 days back. They were slightly better than expectations. We got about 10% earnings growth for our coverage universe of 320 companies and roughly 8% earnings growth for Nifty 50 companies against expectation of 5%. Now, last year, FY25, that is fiscal year 2025, was a flattish year after 4 years of phenomenal 25% compounding earnings in Nifty 500 broader universe. So therefore, FY25 came as a bit of a dampener. We saw earnings downgrade also happening. It's a year characterized by general election, some slowdown in government spending, capex slowdown, consumption was weak any which ways. So all of those factors culminated into a very flattish year on earnings. Now this year, fiscal 26, has begun on a slightly better note. We expect the full year earnings to be at about 10%. Now, the interesting thing for this fiscal is all the big sectors which are heavy contributors like banks, IT, consumer, they are all posting very mid to low single digit kind of earnings growth. The 10% earnings growth is led by sectors which have a very smaller weight in indices like cement, capital goods, electronic manufacturing companies, consumer discretionary, to an extent healthcare, and of course retail. Now, the quarter was driven by some of the smaller sectors. Now, we've seen mid caps, which is the companies which are ranked 101 to 215 market cap. They've outperformed large cap 5th quarter in a row. And we've also seen earnings upgrade happening in mid caps, which is very counterintuitive to what we have seen in rest of the market. Large caps in our coverage universe have seen a 1.5% earnings cut. Small caps have seen about 4% earnings cut. But mid-caps have seen 2% earnings upgrade. So as a consequence of all of this, we have raised allocation to mid-caps in our July quarter preview before the earnings. And we remain very convinced that mid-caps for a second year in a row will once again outperform large cap on earnings growth. And therefore, consequently, the valuation premium that mid-caps have been enjoying for last 3-4 years will continue to stay elevated. And of course, ably helped by very sharp domestic inflows which we are seeing in Indian equities, even as the foreigners continue to sell.
So a very rosy outlook with mid-cap seeming to have a little bit more upside than large caps. So Gautam, I was curious about one trend that I might have noticed, and perhaps a potential divergence in some of these sectors that might be related. For instance, it was highlighted retail earnings actually went up by about 24%, but in contrast, consumer earnings up by only about 4%. In another instance, for instance, you saw capital goods rising by 15%, with cement up by 46%. However, infrastructure was actually down by about 4%. So you're seeing a little bit of a divergence from sectors that might be similar on the surface, and perhaps some sectors doing better than others. Why do you think there were some of these divergences between some sectors that outperformed some that might have been seen as related to them on the surface?
Absolutely right. You noticed the perfect trend that we've also highlighted in our report, that there's a dispersion both across sectors and within sectors. For example, if you look at technology, the large cap technology companies have posted 4 or 5% earnings growth, but mid caps are printing 20-30%. Within consumption, the low ticket items are struggling for last 2-3 years. So consumer staples have posted absolutely flattish earnings growth for last 4 quarters in a row, whereas consumer discretionary is printing at 20-30% earnings growth. And this is valid across sectors. One of the reasons for this is there is a broad-based slowdown in low ticket consumption item, right? Because there was higher inflation, the wage growth in the economy was very, very modest. And of course, we've been coming out of a post-COVID K-shaped recovery, right? And that has prolonged, wherein goods of higher ticket consumption items have continued to do well. Things like jewelry, hotel, innerwear, some of the consumer durables, electronics, they've been doing quite well. Whereas the items of daily necessities, the lower ticket goods, they've been struggling. Now, with the potential GST rate cuts, the GST Council is meeting today and tomorrow. We'll come to know about the decisions in a day or two. We are hoping that even the items of lower ticket on consumption side should get some fillip if there is a rate cut. There are a lot of items that are expected to be brought down from 28 to 18. Let's see what happens actually in a couple of days. But there is a hope that some of these smaller cars, the two-wheelers, cement, staples, all of them should benefit. But for now, it looks as if the divergence between the earnings can continue in FY26, which is why it's become very important to take a stock-specific bottom-up, sector-by-sector view. I know it sounds cliche, but in an environment where the earnings growth is very modest and the premium for higher earnings growth is stupendous, it makes all the more sense to go a little deeper and focus on granular things and look at stock-by-stock, sector-by-sector, bottom-up ideas. Because when earnings are growing at 8-10%, and if you're able to identify 10-15 stocks or 10-15 companies with 20% earnings growth plus, the market is giving them significantly higher premium on valuation compared to the market.
So, Gautam, give our viewers a bit of a hand here, some help actually, with regards to this bottom-up approach that you're advocating. Let's take, for instance, the GST panels meeting and the possible revisions at the moment. If you were to conduct a bottom-up approach to identify some of these winners and possibly laggards based on this bottom-up approach, how would you go about it against the lens or the expectations of this GST panel review that we have?
So one of the most discussed thing for the last 8-10 days, ever since the Prime Minister spoke about the potential rationalization in GST rates on 15th of August, is that auto is going to be the single largest beneficiary in our view, which is why you've seen auto sector as a whole in the month of August rallied about 6%, and so much so that today now, after that 6% rally, auto is the best performing index on a YTD calendar year 25 basis. So we are very positive on auto. Coincidentally, we had upgraded auto sector from underweight to neutral in our July quarter preview. We like companies like M&M, Maruti, TVS, So all of them, basically smaller cars, two-wheelers will benefit as potential GST rate cut happens. Second sector where we are seeing some benefit that will accrue is cement. And as you rightly pointed out, cement sector posted a close to 50% earnings growth. But do remember that it all came on a low base. After a 50% earnings growth, even on a full year basis, if they do in FY26, the corporate earnings in cement in FY26 will still be more or less similar to FY22. But for now, if the cement sector also sees a potential rate cut on GST side, they will definitely be a key beneficiary because the government is pressing ahead on its capex program. They have front-loaded the capex. First quarter, that is April to June 2025, the capex spent by the government was up 52%. And then, of course, you have some staples, the things like Hindustan Lever, ITC, Britannia. Depending on which category gets what cut, they might see some potential benefits. So these are the three sectors where we are expecting a key benefits coming out. And then you have indirect beneficiaries like EMS companies. They should also benefit as demand for ACs and rest of the electronic items go up. But the bigger sectors like bank, bigger sectors like information technology, and then you have sectors like metals, oil and gas, they constitute roughly 50-60% of the profit pool. They will not see any impact on either positive or negative side because of the GST cuts. So sectors which are B2C, consumer facing, they are the ones who should benefit.
Right. Gautam, since you brought up the banks, I do want to talk about that, go back into that one particular divergence. You're not expecting a lot of upside for the banks, but as we mentioned in the first quarter, non-banking financial companies seem to have impressed, actually. Again, can you help us understand why there might be a bit of a divergence within this particular sector between some of the traditional banks and the non-banking financial companies?
Absolutely. We've been very positive on non-banking financial companies, both on the lending and the non-lending side. And if I had to make a further distinction, then we are more positive on non-lending, non-banking financial companies. Companies which are facing the capital markets, so brokers, exchanges, wealth managers, asset management companies, life insurance companies. That is where we feel a huge alpha can be created over the next 3 to 5 years as the capital market penetration deepens, as the household exposure to equities go up. 10 years back, the household penetration in equities was hardly 2 or 3%. Today, it has reached 6%. And monthly basis, we are getting the systematic investment flow plan, monthly run rate of close to $3 billion. So that's almost $36-37 billion coming in the mutual fund SIP as it is called. On the lending side, you have to make a distinction between the gold lenders, the vehicle finance, the mortgage lenders. Mortgage lenders is where there is a bit of a margin pressure, something which we have seen in the large banks too, because the credit growth is a bit weak right now, 10-11%. And on top of that, because of the repo rate cuts by RBI, the pressure on net interest margin is also very evident, which is why the large banks have seen a very flattish to minus 3 to 4% kind of earnings growth in first quarter. We expect the second quarter to be equally weaker, and then things bottom out in second quarter, and gradually from the second half of FY26 and then subsequently in FY27, we should move towards mid-teens kind of earnings growth for banks. But in the near term, next 3 to 6 months, we expect banks to remain very, very subdued on earnings front. And NBFC lending, we are expecting slightly better growth print in gold financiers because there is a pressure on the non-secured side, and which is why most of the households are using their gold holdings for taking credit, and which is why we have seen very strong performance coming in from the traditional gold lenders like Muthoot and Manappuram. But our preference, just to reiterate, is more towards capital market oriented companies.
All right, Gautam, we have to address also the recent trends in the markets. I'm sure you also noticed that recent uptick in global bond yields overnight that was started off in Europe and fed into the U.S. 30-year yield. How close are you folks watching this recent uptick actually? And could this actually pose risks to valuations? Because we know higher yields actually might challenge equity valuations as well.
Absolutely. It's a very important parameter when you construct the valuation equation for any equity markets locally or globally. Our own 10-year yields in the government bond yields in India have hardened in the last 1 month from 6.2, 6.3% to almost 6.6%. One thing I've noticed is that the spread between the 10-year US and 10-year India government bond yield has been the lowest in the last 2 decades, which in a way reflects the lower inherent volatility in the Indian macro. Indian macro parameters have been the best and the most resilient that they've been in the last 10-15 years, be it growth, be it inflation, current account fiscal deficit, the forex reserve, the currency volatility. So India has progressively in the last 4-5 years have become a low beta, low volatility market, which is what is helping India attract a slight bit of valuation premium. If for whatever reason the bond yields equation were to disrupt meaningfully from where we are right now, we don't expect that. That's not our house view. But if that were to happen, then possibly there could be some repercussion on the equity valuation that the Indian markets are currently enjoying. But our base case is that the macros remain solid and resilient and rest of the parameters fall in place, which is basically the only thing missing right now in Indian equation is the recovery in corporate earnings growth. As we move forward in FY26, as the cumulative effects of the fiscal and monetary actions that the government and the RBI has taken in the last 6 months, the rate cut, income tax cut, the GST rationalization, the infusion of huge liquidity through CRR cuts. And of course, we've had a very strong monsoon, third year in a row. So we do expect that all of these things coinciding with the festive season, which is begun last fortnight, all of this should play a very important role in seeing a growth recovery both in the economy and the corporate earnings starting second half, which is from 1st of October.
So, Gautam, do you think that the growth story in India is still justifying these relatively higher P valuations? Last I checked, the Nifty 50 was still at around 23. Do you think that the growth story that is, or the growth narrative, continues to support these levels?
Absolutely. And if you had seen the first quarter GDP print, which came on Thursday or Friday, 7.8% real GDP growth. Clearly, India has remained a growth market, which is why India has always attracted a valuation premium. That is not going to change in the foreseeable future, in my view. Of course, there will be a lot of bumps along the way. Sometimes there will be geopolitics, sometimes there will be trade concerns. But the structural India growth story, which we all are familiar with for the last 2-3 decades, and given the very positive demographics that we have and the structural reforms that we have seen, and government has promised more reforms. Yesterday, we had the Commerce Minister Piyush Goyal addressing our 21st Annual Global Investor Conference. He did mention about a lot of reforms on the ease of doing business, and so many complex tangles in the which are interwoven in the business realities of India. They're going to get untangled. So we are quite hopeful that the next wave of reforms are along the way, along with GST. So the India growth story will remain very, very relevant for, and I'm not just talking about this quarter, next quarter, I'm talking about next 3 to 5 years. Just that we've too contained with a lot of volatility globally along the way, given the kind of scenario that we are living in.
Gautam Dugad from Motilal Oswal Financial Services on the sideline of Motilal's annual Global Investor Conference. Thank you for joining us today on Inside India, and fascinating insights as to what might be driving the Indian growth story and the possible rebound in Indian equities. We'll be back with more news and updates, including the Indian cricket team's hunt for a new jersey sponsor and Tesla's muted start in India. Don't go away. We'll be back in a bit. Welcome back. You are watching Inside India, and some of the stories we're keeping tabs on this Wednesday. The Indian cricket team is searching for a new lead sponsor to replace Dream 11 after the government banned real money online gaming last month. Dream 11 had signed a 3-year deal worth around 3.6 billion rupees, but can no longer promote fantasy sports or sponsor the national team. With the Asia Cup starting September 9, India may play its opening week, including the test match against Pakistan, without a front-of-shirt sponsor. Floods continue to ravage the northern parts of India. In many states, flooded farmlands and hundreds of villages are being evacuated, with rescuers using boats to reach locals. The Indian Weather Office warned of more heavy rains with above-average monsoon rain expected through September. Afghanistan has been hit by a second earthquake, a 5.2 magnitude tremor just days after a devastating earthquake left over 1,400 dead. Rescue teams are still struggling to reach isolated communities, with aid agencies warning the death toll could rise. The Taliban has appealed for international help, and China has pledged relief assistance. Global aid has dwindled since the Taliban took power in 2021, with many countries wary of funding the regime. Tesla's India debut is off to a slow start. Bloomberg reports the EV maker has received just over 600 orders since launching in mid-July, below expectations. Tesla plans to ship between 350 and 500 cars this year, with the first batch arriving from Shanghai in September. Deliveries will be limited to 4 cities: Mumbai, Delhi, Pune, and Gurugram. The Model Y starts at about $70,000, reflecting India's heavy import tariffs. Groups representing millions of small Indian retailers are also pushing back against Amazon. They are urging the government to reject U.S. retail giants' request to ease foreign investment rules for exports. Currently, companies like Amazon and Walmart can only operate as online marketplaces in India. They can't stock and sell goods directly, even for export. Amazon has been pushing for an exemption, saying it would help small sellers reach global markets. But retail and farmer groups warn the move would undercut local businesses with predatory pricing. New Delhi is still weighing the decision. Moving from one Mag 7 to another, Google surging over 7% in the after hours, the tech giant is getting a rare victory against U.S. antitrust enforcers. A judge ruled Google will not have to sell its Chrome browser Android system, removing a major investor concern. But Google must share data with rivals to boost competition in search and ads. And that's fueling some optimism in the U.S. futures as well right now. Take a look at what's being foreshadowed for the open today on Wall Street. The implied open foreshadowing of about a near 5-point gain, that is, for the S&P 500. A bit more dour for the Dow Jones, though, seeing it lose a little bit of ground so far, while the Nasdaq looking at an implied open of up by about 0.1% so far, as we await the open on Wall Street and how they're going to react also to those rising bond yields that we saw overnight. Well, coming up, we will talk about China's show of defense strength in Beijing, with Vladimir Putin and Kim Jong-un of North Korea in attendance. But where does it leave India? That discussion right after a short break. Don't go away. Welcome back to the program. We are counting down to the market open in India, and once again, Nifty futures today foreshadowing just a little bit of a gain, actually, just trending marginally higher today, about 24,643. That is about 63 points above the close on Tuesday. Meanwhile, we're seeing the Indian rupee continue to soften. They are testing record lows once again. We recall that the Indian rupee's record or all-time low is at about 88.14, and that is exactly where it is right now. And we'll see if these trends will hold when Indian markets open in about 14 minutes and 21 seconds. China's top military hardware also on display at the Victory Day parade in Beijing today. From tanks to fighter jets, it's China's largest ever military parade in Tiananmen Square. Xinhua also reporting that nuclear missiles with global reach were also unveiled at the parade. And while we've been talking about tech, artificial intelligence, and trade, one traditional area of competition between the U.S. and China has been in defense. China has said it aims to make its People's Liberation Army a world-class military by 2049 and has been accelerating efforts to make its military more modern and globally competitive. China's arms exports have also been increasing steadily, with the bulk of it going to Pakistan since 2020. This according to the Stockholm Peace Research Institute. China was among the world's top 5 largest arms exporters in that period, while India and Pakistan were among the world's largest arms importers. Fresh off the SCO summit, Moscow and New Delhi are in talks for more deliveries of Russian S-400 missile systems. This according to state agency TASS. India signed a $5.5 billion deal back in 2018, but delays meant that the last 2 units are now due in 2026 and 2027. The new negotiations are to add more missile systems to this existing contract. Russia still supplies more than a third of India's arms, despite U.S. pressure. Now, Sarang Shidore is the director of the Global South program at the Quincy Institute for Responsible Statecraft, and he joins us today to help us at least understand a bit more about the implications and the significance of this military parade that's playing out in Beijing with many heads of state in attendance. Sarang, thank you so much for joining us today. Again, we saw the military parade, we saw the comments or the strong comments from Chinese President Xi Jinping. But from your point of view, actually, Sarang, what do you think is the significance of this particular military parade, both for China and what it's trying to signal globally?
Thank you for having me. Yes, I think the parade was important from the Chinese perspective because we are at a very interesting moment right now in the Asian order and the global order. We are at a moment where the United States is changing tack in a rather dramatic fashion, whether it comes on trade or on security with its allies and partners. And there is a sense of Washington being an unreliable partner of sorts. And this is where China is seeing its opportunity. And with the parade and the summit before that of the Shanghai Cooperation Organization, China is signaling to the region and the world that it is here to stay as a stable player, to provide stability, reliability, predictability. These are the watchwords of this sort of messaging. And the subtle contrast, in some cases not even that subtle contrast, is to the volatility that is perceived to be coming from Washington. And indeed, even in Europe, with the situation fraught due to the war in Ukraine, China is projecting a kind of a sense that we are here to stabilize the region and the global order.
Sarang, I think we've talked a lot about actually the presidency of Russian President Vladimir Putin and the reaffirmation of what was once characterized as the no limits partnership between these two. But I think now a lot of attention has also been captured by the attendance of North Korea's Kim Jong-un with his 13-year-old daughter. It's the first time he's in Beijing actually since 2019. Help us again from your point of view. What do you think this is signaling, and why would this be important for that particular relationship and what North Korea is projecting to the world right now?
Again, you're seeing a sort of a coming together of a Eurasian space, if I may. North Korea, of course, has been quite important in the Russian war in Ukraine in terms of its support, even its troops. That caused potentially friction between China and Russia, but that seems to be managed. And the fact that the North Koreans, the Russians, the Chinese, the Indians and others are in Tianjin and are together is giving a sense that Eurasia is this giant landmass that stretches from really the eastern stretches of Europe to all the way to Asia, is converging in a sense that is separate, if not opposed, at least separate and parallel to what is happening in the West. And the North Koreans are a part of that.
And it's also very telling that when you look at these pictures, Sarang, it's again, might not be a coincidence that President Xi Jinping is flanked by Kim Jong-un on his left and Vladimir Putin on his right. Again, one can't help but think that there might also be a bit of a messaging sent to the United States. We've heard comments, some initial comments actually from U.S. President Donald Trump earlier on today, also pushing back at some efforts to try and undermine the United States possibly. Again, how do you think this might complicate geopolitical tensions, especially since there are delicate balancing acts being managed by the United States and Russia and the United States and China even?
Yeah, it's going to be interesting because when it comes to North Korea, President Trump has signaled positively on possibilities. And of course, in his first term, he did try to achieve some sort of a stabilization or a peace deal. That didn't work. And again, with China, President Trump has indicated that he wants to find a way forward of sorts. Even as the trade war continues, there may be a truce, but there still remain a lot of friction points and uncertainties. So you're seeing the United States in a way, I think there is an uncertainty in its policies towards Asia. Each actor, of course, is separate. They're not all joined at the hip, not the North Koreans, the Chinese, the Russians. But nevertheless, there is more of a convergence among them than not at this point, given where the West and the US is at. And so the signaling is that, yeah, it's not a common front, but it is not entirely separate entities that the U.S. is dealing with. There is a sort of a thin coordination between them, and in some cases more than thin, that presents the U.S. with a formidable challenge.
And one other interesting current that's happening, and many currents happening, coming off the SCO summit and also on this in this military parade, is the presence of Pakistan and India. We have seen in the past that there seem to be rather clear lines, Sarang, with regards to a U.S.-India alliance versus a Pakistan-China alliance. But in recent weeks, we've seen India and China starting to try to thaw the relationship. We've seen the U.S. make overtures to perhaps provide some semblance of support to Pakistan, and Pakistan also courting support from Russia the way Russia supports India at the moment. Do you think that the old lines are starting to blur with regards to these divisions and these alliances, and right now we're starting to see just a little bit more of a graying of these lines and these divisions, sir?
I think you're right. I think what we are seeing is that multi-alignment and hedging is being embraced by all parties. The Indians are doing more of it. The Pakistanis have been trying it for some time, and they continue to do it. And indeed, if you go to Southeast Asia, that is also the flavor. So multi-alignment and hedging is the flavor of the season because uncertainty in the global system is higher. And when there is more uncertainty, then of course rational players spread their risks and spread their bets. And so you're seeing that's the sort of macro picture in the background. Of course, then there are local drivers and local reasons. The US-India bilateral is facing its biggest challenge in 25 years, and that is incentivizing India to find some kind of a stable, even if not very warm, but nevertheless some kind of a stable arrangement with China. And the same is true for Pakistan, even as it's very close to China. It has been seeking actually for some years now also to return to a sort of a working relationship with the US, which I think it is succeeding in doing. So you're seeing hedging as being really the common factor here amongst all.
There is hedging, it seems, but then could there be a scenario where one side or the other, or within this multipolar arrangement, perhaps demand more loyalty or allegiance, especially since we have seen some overtures from some sides that that it's either you have to be with us or against us. Could there come a point where the hedging has to stop and perhaps one party or another demands more fealty in these situations, sir?
Right. So historically, in the Cold War, we saw that hedging was there even then, but it was limited because you had two very powerful blocs that exerted pressure. And there was still the non-aligned movement back then, but it was not very strong, as it turned out. I think today we are in a somewhat different situation. When the two poles we are talking about, and if you add Russia, it's really three, are not as strong because, well, the Chinese don't really have a bloc. Maybe the Russians are a part of it partly, but not entirely in the way the Soviet Union had a bloc. The same goes for Russians. The US has a system of alliances, but of late, those alliances have come under enormous strain and stress. So alliance politics is not very healthy at the moment. So the US pole, although the strongest, is also not the way it used to be in the Cold War era, or even the 90s, especially, actually. So what you're seeing is you have poles, but they are formidable, but they are smaller and weaker than they historically were. And that gives a lot of space for the global south and the non-aligned countries to actually play hedging in a much more artful manner because they have more degrees of freedom to do so, especially the middle powers among them. So I do think that while there will be pressures to conform, as you said, they're unlikely to be very successful.
And so, Mr. Shidori, just very quickly, whenever we talk about China, we have to also talk about Taiwan, especially because of the concerns of possible conflict given those issues. We did note also that the former KMT head, Kuomintang head Huang Xu, was actually in attendance. What do you make of that, actually, and how does that perhaps make the current viewpoint on China-Taiwan perhaps a bit more complicated?
Yeah, I wouldn't be able to comment on the innards of Taiwanese politics, but I can say that there certainly are the currents where Asia is emerging in some form as a integrated, semi-autonomous space, puts pressure on countries like Taiwan to find a place in this order somehow, because the United States is no longer guaranteed to be rock solid with Taiwan's most risky moves. At least that is not a guarantee. And so there will be, I think there opens up a potential for some new kinds of politics across the straits.
Sarang Shidori, from the Director of the Global South Program, thank you so much for joining us today on Inside India. Appreciate your insights to help us better understand the shifting global geopolitical narratives on the back of China's annual Military Day Parade. Appreciate the time once again, sir. We're counting down to the market open in Mumbai. We will be back in less than 2 minutes. You're watching Inside India. welcome back. And we're about a minute into the trade out in India to this Wednesday, and the midweek showing some signs of gains, actually trading just about 22, 23 points in the green, up from yesterday's close, actually. And once again, as we pointed out, the Indian rupee did show some weakness. It's showing just a bit of some signs, that is, of a slight firming up, but again, trending close to those historical all-time weak levels, actually, of about 88.40. It's currently at 88.06 against the U.S. dollar. Again, just paring back a little bit from that weaker session we saw before the market opened. The Nifty 50, though, looking a little bit nifty again, about 24,594 points, in contrast to yesterday's close at 24,579. India's IT giant Tata Consultancy Services also scoring a nearly $650 million deal with Scandinavian insurer Tryg. That's the IT firm's first mega contract of the current fiscal year. Over the next 7 years, TCS will roll out AI and cloud solutions across Tryg's IT operations. Mega deals are rare in the current environment, and globally the IT sector faces slowed spending, project delays, and also rising economic uncertainty. TCS itself recently cut 12,000 jobs, mainly mid and senior level positions. And also just looking at a number of things right now with Tata Consulting Services at about 3,123 rupees per share. Meantime, India is also positioning itself as the world's next semiconductor hub. On day 2 of the Semicon India event, global chip firms are making their presence felt. CNBC TV 18's Ashmit Kumar is on the ground and filed this report for us.
Well, we're here at Semicon India 2025. It's a marked development as far as the India Semicon journey is concerned. Bear in mind that over 33 countries represented here, over 50 large companies, the likes of ASML, Lam Research, Applied Materials, they're all here, present here. They were here for the inaugural session as well, marked by the Prime Minister's speech. There were 3 key takeaways from that speech that we need to bear in mind. Number one, he began with the punchline saying that if oil is gold, then, well, these chips are digital diamonds. And to that end, he went on to say that it's a $600 billion market for semiconductors across the world. It will soon turn into $1 trillion, and that India is aspiring to be a major chunk of that $1 trillion market. Takeaway number one. The second takeaway, and this is with respect to the government support that is being extended. Bear in mind, Semicon Phase 1 had an outlay of 76,000 crore rupees. Here, today, he gave an indication that going forward, ISM 2.0, the second phase, where there will be extended outlays, is something that is around the corner. Sources tell us it's only a few months away. By the end of December is when we can expect the contours of ISM 2.0, and that is a key aspect that a lot of large players who are visiting Semicon India 2025 will be watching out for, to understand what the government's fiscal support program for the industry looks like going forward. That's takeaway number 2. And takeaway number 3, and this is of course more optics, the first made in India chip under the semiconductor program, which is made by the CG Power plant in Gujarat, was in fact today released. It was put out, was presented to the Prime Minister. He in fact clarified that this is the first of many to come, that there is a case of growing capacities. Keynes will be soon coming out with their own made in India chip from their pilot line. Commercial production is likely to begin soon. So clearly the Prime Minister pitching India as a destination, saying that in a world of uncertainty, in a world of geopolitical tensions, India presents a stable option for investors, for companies, as well as for the larger semicon ecosystem.
We're joined by Neil Shah, the co-founder and vice president of research at Counterpoint Research, to talk about these recent developments, exciting developments with regards to the chip space out in India. Neil, thank you so much for joining us today. I do want to start off with the breakthrough announcement, or the unveiling today, of the first Indian chip. I believe it's called the Vikram, a 32-bit processor. Again, it's a milestone, some would argue, for the Indian semiconductor space and their ambitions. But how does this stack up against other chips at the moment?
Yeah, currently most of the development from the fabs perspective and the chips perspective, it's mostly matured nodes. So there are mature nodes and advanced nodes. So if you look at TSMC, Intel, and Samsung, they're mostly on the cutting edge advanced nodes. But there are only 2 or 3 players in the world which do that. Even China does not have it. US and now is having it with the CHIPS Act. TSMC and Intel are there. But from India perspective, I think these are baby steps. We are starting with matured nodes, with everything above 28 nanometer. And these are also critical chips. And these were the chips which were felt the most in terms of supply chain issues when during the pandemic. And that is all led to investments in matured nodes as well, because matured nodes were never invested in before pandemic, and that is where we see a lot of demand for matured nodes as well, and to need for diversification.
Right. Neil, there's been a lot of news and announcements with regard to semiconductor investments into India, but I want to ask you how difficult it's going to be for them to get to build out or to catch up with regards to the chip manufacturing sector. Because as we've discussed in the past, it's going to be very difficult to do that given how specialized each part of the value chain is, from design to manufacturing to even the testing, for instance. Talk to us about what the road ahead looks like for India, despite this big announcement that they just made.
Yeah, the one thing is for sure, India is little bit lucky compared to other countries like Vietnam or Malaysia. Malaysia has been doing packaging for a long time, but what is different with India is India has been a design and development hub for most of these chip companies for almost a decade or more than decade. Like for Infineon has been here for 30 years. Qualcomm, AMD, Nvidia, Intel all have their R&D and design centers, either largest or the second largest in India. So the chip design factory is still well and rampant in India. The next part was the manufacturing, which was missing piece. And now with matured fabs coming in, I think that is laying out properly. The real question is when do the advanced fabs come in, right? It will take time once the ecosystem is set. So if you look at yesterday's keynote, there were all of the leading fab equipment players as well as materials players participating in the keynote with Semiconductor on the first day. So that speaks volumes in terms of they see India as a destination where most of the fabs will be coming in and they can sell their equipment to manufacture chips, advanced chips, right? So I think it's a process. It took almost couple of decades, more than couple of decades for TSMC to be what TSMC is right now. And for India to be there, it will take another decade or so.
All right. Neil, we have to talk also about these deteriorating U.S.-India trade and economic relations. And as we've seen before in the past, we've seen the U.S. actually try to hit China where it hurts with regards to chip restrictions. Could there be a point where relations sour and it might make the U.S. consider similar punitive actions towards India that could then play against some of these chip ambitions?
Right. I think semiconductors have been off limit until now, except for the NVIDIA China tussle for the S20s. But if you look at the broader semiconductor landscape, I think US has not touched it yet, though there have been attempts that to say that, okay, semiconductors are the next, because semiconductor imports are also next to the oil imports for any economy. So it's hard to say at this point, but I think it will be more of a short-term thing than a long-term thing for India and other players, the manufacturers and the chipset players. It's a long-term strategy. It's a decade-long strategy. And for India also, it's not about just 1 or 2 years. It might be delayed, but maybe Trump's term is ending in a couple of years. So you never know what happens.
Yeah, and I guess this also extends to the other broader manufacturing ambitions of India, especially with Apple increasing their investments into India as an alternative to the Chinese manufacturing base. This is something that U.S. President Donald Trump has said he does not like. Again, how do you perhaps hedge against some of these short-term headwinds that could, again, threaten to derail some of those manufacturing ambitions of the subcontinent?
I think it's more about getting leverage over trade negotiations. I think that is the ploy here. So obviously it's a quid pro quo. So we'll have to see how this plays out. But so far, Apple has found a little bit of immunity to get iPhone manufactured. Almost 60% of the iPhones coming to US are manufactured in India right now, right? And it's still a better strategy, diversification strategy for Apple. And they don't have any other markets and a potential market which can manufacture at scale. And there's an ecosystem forming here. So China plus one strategy, then it has to be India at this point. So manufacturers will have to find a way. Maybe the plans might get delayed a little bit, or they will have to circumvent, in the end, the end consumer in US will pay a higher price for their products.
Yeah. So what if that is the case? I mean, what can be done, Neil, to perhaps just quickly, shield this? I mean, basically, it's just a matter of just waiting for 2 years. Just very quickly, Neil, in about 15 seconds.
Yeah, I think it's more about a waiting game and try to negotiate with the US government on wherever it is possible to find a solution and to show them the real picture that in
Right.
the end, we'll have to raise the price and the consumers will pay for it.
All right, so some short-term pain for both the U.S. and India, perhaps, as we wait for some of these to resolve. Neil Shah from Counterpart Research, again, thank you so much for joining us today and on the sidelines and on the back of the ongoing Semiconductor India 2025. And that's all the time we have today on Inside India, but do keep watching CNBC. Access Middle East is coming up next. Have a good morning.